At the moment, the ATO have a balance sheet of $105 billion of unpaid taxes at the moment. So there's $105 billion worth of tax revenue from individuals, companies, and etc. that have not been paid. And when you've got no money in the bank and you can't foresee having a surplus in quite a period of time, then you're going to start getting the watchdogs out. And
you got to recover some of that cash.
Jim Chalmers, Australian Treasurer, he started to open the dialogue again on taxing trust distributions. When will they balloon? You're adding more taxes, you're putting more pressure on people to want to invest. You're not going to have an economy that's growing. You look too far in the past, you get depressed. Look too forward in the future, you get anxiety. So the importance is the now and making sure you're making the right decisions in light of what's in front of you.
Ladies and gentlemen, we are back. Flamingo Property Investing. Mate, we have seen each other 2 times in 6 or 7 days.
I know. I've had the pleasure of having you on my podcast, and I really got to deep dive into behind Jack, and I really got to expose the real you, the person I know, you know, the professional side of you, the brains and the wits. And it's going to be good because today is going to be very factual. We're going to talk about, you know, some really good things out there that you can do today to maximise your position coming up from a tax return perspective, and just talk about what the ATO are targeting.
Because we're in the new financial year.
Absolutely.
It's come and gone just like that.
And new goals, new years, new tax returns, new numbers, new budgets, new buffers. And it's important that you start the financial year right, because if you don't get onto the front foot now, especially if we've got a couple of interest rates due to come in or come down, come in over the next maybe 6 to 12 months, if you haven't got your stuff sorted now, you're going to be behind the 8 ball. And as you know, in property, things move quite quickly, and investing in general. And if you don't get on top of it, you're behind the 8 ball straight away.
Let's firstly talk through the ATO.
Yep.
You know, like they've changed a few things coming into the new financial year. I know as a business owner, no more ATO payment plans where the interest is deductible on those payment plans. It's no longer deductible.
That's it.
From 1 July.
Yeah, any interest that you're going to incur on unpaid tax debt.
Is that just for business owners or any unpaid tax debt altogether?
All unpaid tax debt. So they've just taken it away as a blanket. And the behind it is that at the moment the ATO have a balance sheet of $105 billion of unpaid taxes at the moment. So there's $105 billion worth of tax revenue from individuals, companies, and etc. that have not been paid. The ATO have taken a very hardline stance this year, and I think this is probably going to be their biggest sweep that they've ever done.
Yeah.
Obviously, getting rid of interest as a tax deduction on tax debt is one of them, but more importantly, they're going to be sweeping through all the deductions that business owners and individuals claim, because they've got 10 years, or government's got 10 years of forecasted deficits. And when you've got no money in the bank and you can't foresee having a surplus in quite a period of time, then you're going to start getting the watchdogs out. And
you got to recover some of that cash.
Absolutely.
I mean, I know as a business owner, sometimes I look at my balance sheet in the P&L and I go, where the fuck's all my money? And I just get my accounting team to go and recover money.
Absolutely. So it's a big change.
Because I was reading something the other day about the ATO have put $1 billion now extra funding into their, I guess, auditing and review team.
Absolutely. So huge amount of black hole expenditure. So they've started with the cash economy a couple of years ago and really started to phase out cash, as we all would see. Majority of people now are not even accepting cash as a form of tender. It's all on the card. So it's a way that the ATO can monitor things from an income and outgoing perspective. But more importantly, they're going to focus on hitting deductions. There's just so many loose-ended deductions out there. Working from home, they're going to be looking at. They're going to be looking at car expenses. It's always been easy for someone just to claim car as a cost.
Yeah.
But the ATO is going to be heavily reviewing that moving forward. And the data matching, they have put so much money into data matching for properties now.
How do you mean data matching, and like how has it changed from, say, previous years?
Yeah, so they haven't, in the past, they never collected the data from property managers regarding property rental statements, but now they're going to be collecting all the data from property management software. So they're going to be looking at people's insurance incomes that they've received from insurance payouts, rental, water usage reimbursement, expenses, what type of expenses are being claimed, whether they're upfront or depreciated. The biggest one is now they're getting all the information from the banks.
Right.
So all investment loans are going to be now provided to the ATO, and the ATO is going to be utilising that data to see, well, what interest are you claiming? What interest should you have claimed?
Yeah.
And then more importantly, what's been shown in the return.
Because that's the biggest thing, which I think a lot of people don't actually realise, because people use professional accountants like yourself, but like when you lodge a return, whether it's for business, whether it's for personal, you can essentially claim whatever you want to claim.
Absolutely.
You know, it's essentially like, how trustworthy are you as an individual, or how trustworthy is your accountant or professional? But you can literally claim whatever you want. I mean, if you overclaim and you claim things you can't and you get caught, you're in trouble. But there's no limit to what you can claim until you get caught, right?
Absolutely.
And you see these with business owners all the time, the GST scams, you know, where they claim GST that was actually never paid. And I think it was a big one recently in the paper I saw with a property developer, where they were claiming millions and millions of dollars worth of GST, using that GST to go and buy more sites, but they never actually paid the bills in the first place to be able to claim the GST.
And there's other big scams out there, like the Plutus payroll scam about, unpaid PAYG. So it's a self-assessed tax system.
Self-assessed, that's the word I was looking for.
Yeah, self-assessed tax system. So you essentially will assess your own deductions. If you've got a professional, obviously they'll help you and guide you of what you can and can't claim. But if you do something silly, they will pick you up.
Yeah.
And the data matching software they've got now is so sophisticated. And the penalties, shortfall, interest charges, penalties, and penalties can be up to 85% of what you've claimed incorrectly. So it can be a very expensive
meaning you
exercise.
overclaim by $100,000, for example, a potential $85,000 claim.
Absolutely, $85,000
Fine.
penalty plus the refund that you received, or the tax benefit you received paid back. So no more is the ATO being generous. We've had a pretty good run as taxpayers during COVID. The ATO did support a lot of small businesses and individuals through the toughest time probably in the last 50 years.
Yeah.
But those days are gone, and the ATO have a $105 billion deficit that they need to start to collect, and property investors are on the radar, have been on the radar, but are going to be targeted quite heavily this year.
So for you as an accountant, you've obviously gone through and done everything you can for end of financial year. You're rolling into a new financial year with knowing this information that the ATO is going to crack down harder than ever on certain things. What's the type of advice you're giving to your clients, and what are the things that you're putting in place now to make sure that people don't come unstuck in the future?
Yeah, so we've got some very comprehensive checklists for clients, and I think that's always the biggest thing, education. I've always had I've always been of the point that as an accountant, I'm there to give as much IP as I can to my clients, educate them, make them as good as what you are, because it's going to make your life easier. Don't try to hold all the information, because it's only you that loses out as the professional and the individual.
Yeah.
But understanding what's happened throughout the year and just speaking to your client, getting a bit of a greater knowledge of what's happened from a property side of things or a work-related side of things, and going that little bit deeper. So biggest things that I'm seeing that always get missed on new clients is they may have just refinanced a loan and moved their loan from CBA to St. George, for argument's sake.
Yeah.
They've paid lender's mortgage insurance and they're into year 2 of the claiming of the mortgage insurance. Where anyone out there, when you pay LMI, you get to claim it over 5 years, prorated on when you've initially paid the LMI. But if you've moved from one bank to another, any remaining lender's mortgage insurance that hasn't been claimed, you can claim it as a one-off expense.
Right.
So that's one thing that's missed, and that's just not being silly and not being dodgy. That's
so if you claim year 1 of 5, and then in year 2 you move it to another bank, the remaining 4 years you can just claim as one deduction.
Absolutely.
Interesting.
And they're the things that you can improve, and they're the things that you can claim back without having to do silly things. Depreciation is a big one. We all know that claiming depreciation, diminishing value of the assets.
Yeah.
But if you've got a depreciation schedule being done, and for argument's sake there was a dishwasher in that home, that dishwasher is now broken and been thrown out, and a new one's been purchased. Well,
the existing value of that old one?
Correct.
Yep,
any existing value of that old one can be claimed up front.
Yeah.
So it's not just a matter of getting a report, chucking the number in. Have a look through some of the costs that are there and chat with the client. Hey, is the dishwasher that we've got 2 years left to claim, have you still got it? No? Well, let's write it off. So there's so many things that are available to us to be able to improve our position. It's just spending that extra 10 minutes with your professional to go through it. And
a lot of little things add up, right?
Absolutely.
I did a post yesterday or the day before about, how we've spoken about it, I think, on another podcast with PAYG tax variations, right? And the way that I look at it, it's essentially like with a tax refund, which everyone, if they're intelligent, are getting their tax returns done as fast as possible, because I want that money back in my bank account versus sitting in the ATO's bank account. But essentially, you've overpaid your tax for the last 12 months, right? Like, that's what a tax refund is. It's you getting your money back that you've overpaid to the ATO. And just like the ATO this year is going to go after lots of people who owe them the $105 billion of tax debt, you as an individual or you as a company, if you are owed money from the ATO, you shouldn't wait longer than you have to wait to be able to get that money back, right? Because it's essentially an interest-free loan to the ATO.
Absolutely.
So the good thing with the tax variation is instead of waiting to the end of financial year to get a big lump sum return, you can claim those things during the year and get obviously a net increase in your pay.
Yeah, and the whole month of July is for us doing a lot of PAYG variation for clients, and that's just, again, proving their income position, their net income position. It gives them the opportunity of being able to hold their properties longer, especially as interest rates are where they are. But if interest rates do come down, they're still in a very good position to be able to buy more investments. And in the end, capital flows through to investing, and investing flows through to wealth.
Just on that, so every year you have to lodge a new tax variation every July?
Yeah, every year you have to lodge a brand new variation because your forecasted expenses or income may change. And if there's any material changes throughout the year, which would drastically change a PAYG variation, it's always encouraged to lodge a new one.
Meaning you earn more money, or you have another investment property you didn't have the year before.
Correct. Or there could be something that you sold and you don't have those expenses anymore, because the last thing you want to be doing is understating your taxable income. ATO doesn't like it. They can enforce penalties and interest, but at the same time, you don't want to be left owing tens of thousands of dollars of tax that you didn't think you had an obligation to pay. So those buffers become important, and in being in tune with your financial circumstances.
Does it ever go the other way, like you overclaim and then you've got a tax bill?
Yeah, many times. Yeah, many times. So there might be, clients who might just put a granny flat on there, or, significant rental increases. I did see that during those low interest rate environments for clients on PAYG variations. Rents were essentially doubling in the space of 6 to 12 months.
So they got more income.
And they'll pay more tax at the end of the year. But, for the people that are sophisticated, they knew it. They took it as a bit of a benefit, put the money aside, had it in their offset accounts, ready to pay the bill when it came through.
Paid the bill at the end. What else are you setting people up for this new financial year?
So big one is buffers, and more importantly, working with clients to get an understanding of what they want to be achieving over the next 12 months. Now, we've all heard it. Many professionals talk about it, but more tax is more profit. More profit leads to more lending leads to more wealth. So for a lot of people, as we start to see potentially rates come down, there's going to be doors and windows that will present themselves as opportunities for people to start to expand their wealth.
For more borrowing power.
Power. Now, if you are one of those professionals where you're just focusing purely on minimising the tax for your clients, and that means absolutely cramming everything in as a tax deduction that you possibly can without truly looking at the nature of the cost, well, you could be selling yourself short for the ability to be able to leverage into assets. So I'm working through clients not just from a tax planning perspective, but from their wealth planning perspective, and making sure that I'm one of those advisors that's helping them, not preventing them.
When you say buffers, are you talking buffers around like cash in bank, buffers around like how much profitability we need to show to be able to get the lending that you want to do? Like what does buffer mean to you in that sense?
Everything. So cash at bank's important because we need to make sure as we invest, we've got our ring-fenced amount of money. But buffers around the level of profit that we need and the borrowing capacity that we're after. And then the ability from an equity position, making sure if there's any little things we can do to improve the asset position, and it could be as little as just getting that kitchen done today. That could be the difference of you having another deposit to be buying assets in potentially an interest reducing environment, which for many people they haven't seen for the last 24 months.
Exactly. What about budgeting for business owners? Like I know sort of May, June, we finalise our budgets for the new financial year. We're very clear on all of our metrics, KPIs, what we need to hit for this financial year. Are you doing a lot of that with your clients, and can you also do it with PAYG style of employees? Go, hey, this is where you're on right now, this is where you want to be, and this is what needs to change for you to be able to get there? Yeah,
absolutely. Everybody can do a budget, regardless if you're an individual employee or small business, medium or large business, and it's encouraged. Have a chat with your professionals. There is a cost. No one's going to be sitting down and doing that for free for you. But
you don't work for free?
No, not at all. No, we've still got our bills to pay, and there's still overheads, and the government still charges us tax as well. But if you've got the time or you've got the know-how or the money, then if you think it's going to be worthwhile for you, and, as a professional, I always will say it's worthwhile, you need to be doing that, and that's going to set the tone for the whole year. Because knowing what you have to play with, knowing the rules of the game before you start it, I think is important. I've never gone into a soccer match before not knowing that if I slide tackle and hit him in the knee, I'm going to get a red card. So you need to ensure that you've got the playing field being set, and you've got direction of where you want to be.
How many business owners, because I know when I first started the business, I had no budget and no really direction of what I wanted to hit, how much revenue, what that looked like on a monthly basis. How many business owners go into a financial year just sort of going, I hope this year's better than next year, and don't actually set monthly budgets to know top line, what the GP needs to be or gross profit, and then what ideally we're targeting from a net margin point of view?
Small businesses, I probably dare say 80% plus.
Wow.
Small businesses, because they're so stuck in the operational side of what they do.
Yeah.
They're on the tools or they're in the trenches and they're working their backside off. Medium businesses, obviously, budgeting is quite important. Large business, it's a must and a necessity.
Yeah.
But small businesses, they probably should be focusing as much as they can on the business, in most cases while being in the business.
Yeah.
But life gets really busy and sometimes you just need to spend that little bit of extra time. But I am seeing a big change and a big shift, especially with my small business client base.
Yeah.
They are starting to understand the need of having to work on, and that is your budgeting, forecasting. The majority of people would have a bit of an idea of what they need to achieve, but I think putting it in writing tangibilises it and sets the tone.
Mate, it's been game changer for us. Like, I know every month now what we have to hit top line. We obviously have different months in our sort of sector where it's, busier and slower. I know what we can spend on marketing. I know what our payroll is going to look like. I know what our gross margin is, what our net margin is. And it gives you a very clear KPI to work to every single month, and then also the team to work to.
Absolutely. And one of the most important things I'll do with any of my clients, and I know you do it as well, and most other medium-sized businesses do it, is understand your break-even point. Knowing, yes, how much we need to turn over, what our expenses are, and budgeting is important, but knowing what you need to earn to keep the lights open is important, especially as you're starting and wanting to grow your wealth. You need to make sure that, hey, this is covered, because there's nothing worse than being an employee or a business owner and struggling from a finance perspective, but then also having one eye on the future. Because as I said to you, when we had a chat, you look too far in the past, you get depressed. Look too forward in the future, you get anxiety. So the importance is the now and making sure you're making the right decisions in light of what's in front of you.
I'm often spending too much time in both of those areas. What about the new changes for superannuation? Superannuation as of July 1, from an employer's point of view, has increased now as to how much you have to pay your employer or employees. And then from an employee's point of view, obviously your contributions are going to increase in relativity to your income.
Absolutely, 12%. So
which is up from 11.5.
Up from 11.5.
Yep.
So it's been about a 5-year journey to go from 9 to 12%. And as of now, we've now hit the target, which is what was set by the government, maximum of 12%, as what they call a superannuation guarantee.
Yeah.
So all employees will be receiving a little bit extra in their super. All employers will be paying a little bit extra as a result. But what that means now is there could be other opportunities for people to start having a higher balance of superannuation and looking at their super more carefully.
Yeah.
And that means you've got more going in, means there's more view, more vision and more scope to make sure you're doing the right thing with your super. As an employer, unfortunately, it's another cost that we have to be burdened with. But nevertheless, it's one of those things that's been there for a long time.
Yep.
It's not new, and we've seen this upcoming for quite a while.
And the cap is still a 30,000 per annum for concessional?
Cap hasn't changed.
Yep.
30 grand concessional cap at present. There's no scope that I can see so far of it going up. But what we do have coming in as of 1 July, and I believe it's just past the lower house, is the Division 296,
which is over 250.
No, Division 296 tax is the unrealised unrealised tax on $3 million total superannuation balances. So they've desensitised the name. This is how crazy it all is. It is an unrealised tax, and that's what the scare campaign was. But the government's desensitised the name by calling it Division 296 now. So, if you're lucky enough and fortunate enough to have a total superannuation balance over $3 million, there'll be a little bit of Division 296 or unrealised tax that needs to be paid. And there's accountants working in the background frantically trying to work out ways that we can minimise it for clients.
So it's passed now?
Lower house, I think Senate now will be debating it. There may be changes or they may let it go through. But with the Labor win, they're pretty much certain to get it passed through the upper house.
Right.
And 1 July 2025, welcome to a very new realm of taxing on unrealised gains.
Right.
I think it's going to open the doors to many other things.
What do you think is going to happen for people? Like, it's $3 million per person if you have a self-managed super fund, right? It's $6 million total. What do you think is going to happen to people that are in that position now? Like, where do you think the money's going to start flowing outside of the minimum you have to do inside a super? Because obviously people aren't going to want to put things in there to get them taxed at a rate which is probably somewhat similar to what you could do outside of super, like in a company structure.
They'll look at what the taxing is on the unrealised gain versus what the taxing would be outside. There may be a little bit of a flow outside superannuation, but I think you'll find that for most people at that balance, they probably will leave it in there because the tax with inside super on the unrealised gain might be still cheaper than outside.
Yeah.
But it depends on the type of assets they've invested in. If they've got very, heavy capital moving assets with absolutely very little cash flow attached to it, I think you'll find that there'll be a move away from that asset class.
Yeah.
In super,
Like
that
real
is.
estate, for example.
Potentially like real estate, very high capital moving, low yielding. But if it's, high yielding and very low capital movements, then you might find that people say, well, it's only a very small amount. So it'll be interesting to see the strategies that come from it.
Mm-hmm.
Again, more so, it's just another fear of, the unknown. And for me, it's not so much the Division 296, it's the doors that it allows to be opened. And if they can tax unrealised movements and gains in super, then they're going to start taxing other things. And again, I said earlier, we've got 10 years of forecasted deficits, $105 billion on the ATO's balance sheet of outstanding tax. Money needs to be collected, and that is just another door that they've opened to start introducing more taxes.
Generating revenue, yeah.
And it started with Division 293 many years ago, where the threshold was 300 grand. So for anybody out there, Division 293 tax, when you made $300,000, including super contributions, you got hit with this additional 15% tax on the contributions that were in the fund, or the balance above the 300,000 cap. Julia Gillard, after her very short stint as our Prime Minister, she reduced that threshold from 300 to 250. And it has not changed for literally the last, 8 to 10 years.
Right.
So, everyone's got a lot of bracket creep. Everyone's incomes have gone up. We've had exponential movements in wages. But our Division 293 threshold has not changed.
So run people through how that works, Division 293. So
yeah, so
250?
250, you make a $230,000 income as an individual. You've worked your backside off, and we all know that it's not free. You're working your 60, 70 hours a week. You're getting another, $20,000, $30,000 worth of superannuation contributions. You're now getting taxed an extra 15% on those contributions above the 250 limit.
Right.
Now, that's, for some people, could be the difference of a couple grand to, $3-4 grand a year, which you can release from your superannuation if you wish to, but it's still a cost. It's still an out-of-pocket cost and a diminishing value of wealth that's going to the ATO. And the challenge is that it hasn't been indexed. More and more incomes are getting up there, and to live in Australia, you need a solid income to do well. Everyone's going to start paying this extra auxiliary taxes.
Yeah, because you go over.
Because you go over. So that's the door.
So
there's more doors
not only
opening.
is the 45% plus 2% Medicare levy and up over 190, you've also got this on top.
Absolutely.
Yeah.
And we've had the stage 3 tax cuts, as we all know.
They've come into effect again.
Well, they were taken away by the Labor government or reduced. And, given a portion of that stage 3 to the lower income earners who, yes, we all know that needed it, but it's that middle income earning bracket that needed the biggest amount of help and didn't get it.
Has there been any change as of July 1 with those tax cuts, or has it been the same as it was last year?
Everything that was tabled is gone through. So, a little bit of a reprieve here and there, but we're talking about that $5 a week, that cup of coffee a week of tax benefit. Again, not enough to to cut the cake, especially in the environment we're in.
The big, beautiful bill, or whatever it's called, has just been pushed through in the US,
US, yes. Yeah. So as Donald Trump's baby, while they're saying that it could result in inflation, a lot of their economists are saying that's going to be probably one of the biggest and best things to hit the US as far as an economic spending plan. We all know Elon Musk is a little bit upset because he's lost his EV mandate of having, pretty much all vehicles being EV by 2030. But that's the type of policy that Australia needs, and we haven't had for a very long time. We haven't had politicians with an economic plan and a business mindset to get Australia into a position where we're humming again. And just on the way here on the radio, Albanese's calling for big business to do their part in providing growth to the economy, but I don't think we have a government which is conducive of those words. They're not giving big business the opportunity to grow the economy, and if in fact they're just hitting more and more people with more taxes, more red tape, more bureaucracy, and it's becoming really tough to turn a dollar in business.
Well, there was the largest ever year of insolvencies the last 12 months.
Yeah,
right?
and they're just, I think the 814 cafes in Sydney alone, closed their doors in the financial year ending 30 June.
Hard game, that hospitality game.
Absolutely, and I think people need to understand, and not just people, the politicians need to understand that running business is damn hard. Running people, dealing with people, money, budgeting, there's a hell of a lot on our plate, and trying to invest for our future. We've got all these things we need to look at, and they don't make it easy to do it.
No, well, I mean, fuck, they're running a country, right? The country's just like running a business at the end of the day. You've got people who live in the country, which is essentially like staff in a business and all the things that go with it. None of them can run it very well, so...
And that's why I love Kerry Packer. He's all about, paying the right amount of taxes, but he's not going to be donating too much of his money to the wrong causes. And, I agree with one thing that he did say in that commission. He said, you introduced 1 or 2 or 3 new taxes, which is fine, or policies, but you don't take away the old ones.
Yeah.
And that's what we're having now. We're just having a stacking of policies and taxes without reviewing the old ones. And that's contributing to the, this big balance sheet the ATO have of outstanding tax debt, because it's just a lot of people drowning. But it's up to us as individuals and business owners to get on top of our finances and make sure that we've got a business that's roaring. Because as you've said many times, no one's going to look after us in our future. No one. We've got to do the things today to make sure that, we're in the best position to look after our own retirement, and that starts with putting in the hard yards today.
Agreed. Any other big changes to the taxation system or things that business owners, higher income earners should be aware of moving into the new financial year that's different from last year?
Yeah, so the big one is the emphasis on fringe benefits, and this is more aimed at all the tradies and small business owners in general. But fringe benefits is when you've got a company, for argument's sake, that's paying for benefits on behalf of staff and employees, which is not a tax deduction. It could be a car. You could be giving them a computer to take home. You could be paying their health insurance. You need to make sure that you're paying your fringe benefit tax, which is a tax on the private portion of the cost the business has spent in relation to the employee. So a lot of tradies who might be running their own business have their 4x4 with the roof racks and the sunshades and all the camping gear. Unfortunately, that's all not work related. Even though you've paid it from your business, you need to make sure that you're at least doing an employee fringe benefit contribution, which means giving back to the company the private portion of the cost that you've expensed, or lodging a fringe benefit tax return, because if you don't, you are in the crosshairs of the ATO. They are going as hard as they possibly can on motor vehicles in businesses, especially people driving luxury cars in their company. They're coming after you. So that's probably one of the biggest things that I can say to anybody out there. If you're running a little bit of private costs through your company, make sure you're lodging your FBT return, fringe benefit tax return, or doing an employee fringe benefit contribution. If you don't, you're going to be in the crosshairs of the ATO.
Interesting. Any other things like that, or is that the big one, along with the obviously the ATO tax debt and no deduction now on the interest you're paying?
They're probably the two biggest ones. A couple other things that are coming out from the ATO as well is a lot of Division 7A.
Now, again, directors' drawings.
Everyone who out there, Division 7A, if you're drawing money out of your company and you're not, including it or disclosing it as a dividend or a wage, then it is a loan, and that means you need to pay that back to your company with interest, which is accessible in the company and non-deductible to you.
Unless you've used that loan for an investment.
Unless you've used that loan for investment, you've got a deed of loan or arrangement with it. But if you haven't, you've just used it for personal drawings or used it to pay off your own home.
Go to Europe
or any other things like that, the ATO are going hard at you. They estimate there is a huge gap there at the moment of Division 7A loans that aren't being disclosed correctly in tax returns, and they're going to be putting a very close emphasis on chasing small business and businesses in general of all the money they've drawn out that have not been disclosed as a Division 7A or a proper deed of loan. So if you've taken money out of your company, get it back in, or get your arrangements being done, speak to your accountants, get your Division 7A contracts and loan agreements being done, because if you don't, there are extreme repercussions, which can result in an unfranked dividend, which means a double taxation. So you're not only paying tax on the profit in your company, but then you're also paying tax at full rate on that amount of money you've drawn out. Name. So that can be upwards of, maybe 70% in tax. And it's a very damaging amount if it's not done correctly.
What was that big thing recently that I saw? It was a tax case around loans out of a trust and whether it was classed as a Division 7A.
Bendel's case, it's called.
You know the one I'm talking about?
Yeah, Bendel's case, the difference of a UPE and Division 7A.
Yes.
So where a trust would distribute to a company and that money did not flow, it'd be treated as what they call a UPE, and there are times where the money has to go in to pay off that UPE, and there's a tax income, an interest income and an interest deduction.
And what's a UPE?
A UPE is an unpaid entitlement, unpaid present entitlement. So your trust has said, I've distributed the money to the company, but the company hasn't received the cash.
Right, so the money's still sitting in the trust.
Money's still sitting in the trust, being used to maybe pay down debt. There's an interest calculation that's accessible and deductible, where Division 7A is that there's an assessable income but not a deduction on the other side.
Right.
I'm still encouraging people, because the ATO have appealed the Bendels case, I'm still encouraging people that if you're making a distribution from a trust to a company, make sure the money flows through. And then in that company, where you've got a beautiful tax benefit, quarantine tax of maybe 25 or 30%, use that money to invest. Don't let it just sit in cash. Turn that company, that bucket company, that corporate beneficiary into an investment entity, and go out there and use the money and try to generate more returns.
And then I think another thing as well, which I've done a few videos on it, and I constantly get comments around, the difference between the 25% tax rate for a actively trading entity versus the 30% tax rate, which would be, classed as a investment company or a passive
entity.
How do we change the tax rate from 30 to 25? I mean, it's the 80% rule, right?
Correct.
More than 20% of the income going into that company needs to be from sources outside of being an investment.
Correct. So it has to be active income. So if you're running, for me, an accounting firm, majority of my income comes in from accounting services. And if I get some distributions from passive investments, my tax rate would be 25%. But if 80% of my revenue is coming in from passive sources, then it's a 30% tax rate. But what people need to understand, tax in a company is a franking credit, and there is tax paid at the tail when you issue it as a dividend. So sometimes when you pay tax in a company, you might actually get the whole thing back, depending on your circumstances, under a franking credit system. Or sometimes you get none, or you might get a small amount, or sometimes you pay a top up. So don't be too worried about tax in a company. It's more so when it comes out of the company, that's where you need to be worried, and that's where you need to make sure you've got all your tax strategies in place to ensure you're paying no more than what you've already paid, or maybe getting a bit of refund back.
There we go, which essentially means for if you've got a lot of franked, I guess, profit held inside of a company, you could potentially push that out of the company into yourself as an individual and pay no tax on it, or get a refund from the ATO.
Correct. Correct.
Which is a common strategy inside of superannuation, right? When you go into that tax-free retirement, if the dividend that's getting paid to the super fund has already paid tax, or it's franked, and inside of the super fund it's tax-free, you'd actually get that as a refund, which makes your net income higher.
Correct. And I probably would say one of the last things that I've seen is it's come up again. It got quashed when Bill Shorten was in trying to go for Prime Minister back when they were versing Scott Morrison. But Jim Chalmers, Australian Treasurer, has opened the dialogue, and it goes back to what I said about the unrealised tax on super, Division 296. He started to open the dialogue again on taxing trust distributions. When will Labor learn? You're adding more taxes, you're putting more pressure on people, and more pressure on people to want to invest. You're not going to have an economy that's growing.
How does that differ from what's in place now? So what does it look like? They're taxed trust distribution.
So, the flexibility of being able to distribute through a trust is to have your beneficiaries who ideally are on lesser income tax than you. And it could be a beneficiary that might not be working. Your wife may be at home looking after the kids, and it's a little great opportunity just to get some money out of your investment entity, pay very little tax. This 30% tax rate discussion, Jim Chalmers talking about it again, means that, if you're going to be distributing to your wife that's not earning any income, or your husband, or whatever it may be, adult child, they're going to do a flat 30% tax on that distribution. Again, comes back from opening more doors, adding more taxes to cover this deficit. It's talk at the moment, but who knows? They've got another 2 to 3 years left, and a deficit to fill, and a balance sheet of the ATO to pay back. And these are little things that start to creep in as we now have our ticket revenue, which is royalties from mining, and revenue from profits all starting to come down. We need to find the sources from somewhere.
Interesting. Very interesting. What's Jeremy doing for the next financial year? What's Jeremy looking at? How's he thinking about business? How's he thinking about investing?
So I've geared myself up. I've spent the last 12 months, I've bought some really good commercial assets in the last 12 months, and some residential assets, and I'll be going through the builds of those. And the reason why I've bought those and starting the process of building is I do feel we're going to have a movement towards investing again, a strong movement towards investing again. As interest rates come down, more borrowing capacity will start to be opened up. A lot of people have been on the sidelines. I've got so many clients that have been on the sidelines waiting for rates to come down.
Just due to borrowing?
Just due to borrowing. They've got the capital there. They just wanted to get that sentiment back, that feel-good feeling, and they're ready to go in. So it's on the tip of everybody's tongue. Rates are going to come down and properties go up, even though myself as an accountant, when rates are coming down, the economy's not doing so great. But that's only a small section now of the economy that's probably not faring the best. However, there's going to be a huge push we've had a substantial lull in building, and I manage lots of builders, and I can tell you now they've built a quarter of what they were doing, say, 3 years ago. So we haven't had as many dwellings come into the market brand new.
Yeah.
We've got a significant amount of pent-up demand waiting to go into the market. And for me, I got in early while building prices, I think, were relatively stable. That may change. And hopefully I'll be producing some brand new assets to be putting on the market to sell and taking advantage of lower rates, significant pent-up demand, and much more confidence enter into the market. I do think we're going to have a big rally in as the euphoria of rates coming down, starts to hit home.
Yeah.
And I feel if you're probably not getting in at that stage, you might feel that dog's kind of bolted out of the gate, or the horse is bolted out of the gate.
Yeah.
And you might be just running behind it to catch up.
That's right. You'll have to jump on board with Henderson. We'll sort you out. All right, mate. That was awesome. I really appreciate it. So it sounds like takeaways from this is if you're a business owner or you're a higher income earner, business owners need to look at FBT and make sure they're declaring what's necessary. They obviously need to make sure they're paying the right superannuation, because that's obviously changed from July 1. Few tax changes, the new unrealised capital gains tax coming in, so be aware of that and plan with your accountant and financial planner on strategies, and get ready for a cracker property market by the sounds of it.
Love it.
Thanks, legend.